Okay, next we're going to learn how to swap your hard-earned tax dollars for high-growth positive cash flow assets and then combine the power of your mortgage in half the time. Let's take a look at a family home or principal place of residence. Most people choose to buy and own their own home. With this example, we've got the net wage of the average person. First they take out your super, then your tax, and what's little left after paying all those bills goes towards the mortgage. This will be the hardest thing you will pay because the money must come out of your take-home income, your after-tax dollars, and you're getting no help. All of the repayments for the family must come from after-tax money. But what's even worse is when people buy an investment property thinking they're doing something good for themselves and their family, but they don't use a tried and tested process. So they sabotage their take-home income even further by not understanding the numbers, and most people actually buy the wrong type of property in the wrong area at the wrong time, which means that most of the servicing of that investment property comes out of the take-home income. Now, this is something you absolutely must not do. I want to help protect and teach you to become a savvy investor. I want to show you what the new school buyers are doing, the new school strategies about buying investment properties and using very little, if any, money out of your own pocket as far as servicing goes. Now, let's take a look at how we can maximize income by the efficient use of depreciation. Depreciation is what enables you to reduce your tax. So, which properties are suitable? We'll look at this property here. It's $423,000 pre-1985. Depreciation is zero. That's right, nothing. And then we've got this other example here, built in 2003. Depreciation is $2,200. Now, same value property but built today is a powerful $11,898, and that's very powerful. So here's an example of what we call a depreciation schedule, which is done by getting a quantity surveyor. It's a vital piece in the whole strategy. It's a vital piece of the puzzle with claiming depreciation, the $11,898, which I'll highlight and run through and show you exactly how to use this to lower your tax. So, now this is a powerful piece of the puzzle, the best part, at which some of the most sophisticated investors are not even aware of, is how to get that money back on your weekly or fortnightly basis and not wait until the end of the financial year. This is also how we can turn a negative geared property into a positive geared property I mentioned earlier, so you have no weekly expenses. In fact, now actually putting money into your pocket each week, and this is done through what's called an income tax withholding variation, or ITWV. So what happens is we get a depreciation schedule, and then your accountant fills out an ITWV application to ATO. That gets approved, and I'll show you in the next slide how it works. So this is a normal pay situation where you're getting around $2,000 a week. $1,410 goes into your net pay. $590 ATO, the tax man. But we're smarter than that. What we're going to do is get a tax variation. So we're going to get $1,495, and then the ATO is only going to get $505. And we're going to end up with $85 per week back in our pocket. Now that's very powerful cash flow. Basically, we have two choices. We can give our money to the tax department or invest in property, positive property. We can go old school or the new way. What would you prefer to do? How does it work in real life? Well, here's a real life example. The price of this property is $450,000, and total loan is $456,000, including all costs, legals, and stamp duty. $450 rent plus 85 tax variation we mentioned in the last slide equals $535 income weekly. The interest on this will be $438 plus $66 costs, a total of $504 outgoing. So $535 minus $504 equals $31 positive cash flow. So let's look at this example from another angle. So on the left side column, we've got a person or a couple with no property, and on the right hand side with a property. So let's say they're making $110 salary. Well, the salary is the same, but the tax with no property is $30,000, where the tax after ITW of $85,000 a week is $26,000. So the take-home pay is dramatically different. Instead of $79,000, it's $83,000. Then you've got no rent because you've got no property, but with the property it's $23,000. Total income $79,000, total income $107,000. Interest $0, plus interest $22,000. Miscellaneous costs $4,000. So $79,000 instead of $81,000. Weekly $1,527 instead of $1,558 equals $31 positive a week. Okay, so how to legally reduce your tax to virtually zero. Let's look at this example again. If we go to this example, we've got $30,532 minus $26,112 equals $4,420 per annum. That's for the ITWV that we worked out on the other slide that we're getting back for each depreciation. So 30,532 divided by 4,420 is 6.9 properties equals zero tax.